Welcome to The Harvest, Understanding Dividends. This video will guide you on how to cultivate your portfolio to earn regular income by turning ownership into cash flow. When you buy a stock, you become a partial owner, receiving your share of the profit. If a company makes a profit, they can keep the money or pay it out as a dividend. It's like a thank you note attached to a check for shareholders. But remember, dividend payments must be explicitly approved by the board of directors. We can distinguish between growth stock, like a redwood, which reinvests earnings for massive expansion with no fruit today for bigger growth tomorrow, and dividend stock, like an apple tree, which produces a reliable harvest every season. Common dividend sectors include basic materials, oil and gas, banks, and utilities. Companies pay dividends as a signal of financial health. It serves as proof of profit, building trust with consistent payments. However, a huge dividend might signal a trade-off, prioritizing payouts over new growth projects. Let's review the mechanics of the payout. The process starts when the company earns a profit, followed by board approval and the declaration date. Finally, the cash hits your account. Dividends are usually quarterly and can be paid in cash or sometimes stock, with occasional special dividends. To receive a dividend, you need to be on the guest list, meaning you must own the stock before the deadline. The declaration date is when the amount is announced. The record date is the cutoff date the company checks its books. If your name is on the list, you get the check. The critical rule is the ex-dividend date. You must purchase the stock before this date to qualify for the payment. If you buy on the X date, the seller keeps the money. There is no free lunch in dividends. They are a transfer of value. For example, if a stock trades at $63 and pays a $2 dividend, the price naturally drops to $61 on the ex-dividend morning. Your total value remains the same, just distributed between stock and cash. To evaluate the fruit, use the dividend yield formula. Annual dividend divided by share price equals yield percentage. This percentage tells you how much income you get relative to the price you pay, allowing you to compare different stocks. To ensure the yield is safe, check the payout ratio, which is dividends divided by earnings. A ratio less than 75% is healthy. A ratio over 100% is dangerous, indicating an unsustainable dividend that is likely to be cut. This is like a farmer eating their seed corn. Beware of the dividend trap, a red flag where a yield looks high simply because the stock price crashed. High yield does not equal a safe bet. Takeaway: yields that seem too good to be true often signal a struggling company about to cut payments. You don't have to pick individual trees. You can use the basket approach by buying funds and ETFs. Stock funds collect dividends from many companies. Bond funds pay monthly income based on interest. The benefit is instant diversification and reduced risk. Experience the magic of compounding with a DRIP, or dividend reinvestment plan. Instead of spending the cash, use it to automatically buy more shares. The next quarter, you earn dividends on your original shares plus the new shares. This total return is the engine of wealth building. The fine print involves taxes. Dividends are generally considered taxable income. Unless held in a tax-advantaged account like an IRA, you'll owe taxes each year. Qualified dividends are taxed at a lower capital gains rate, while ordinary dividends are taxed at your regular income rate. Here is your harvest checklist. Check the soil for established companies with sustainable payout ratios. Watch the calendar and buy before the ex-dividend date. Inspect the fruit. Don't chase the highest yield blindly. Replant by reinvesting dividends to maximize growth. And finally, be patient. Happy investing!